I am Stephen Spencer, a partner at SMB Capital, a proprietary trading firm in New York City where we trade stocks, futures, and options. In today's video, I am going to walk you through my process, how I identify places to potentially get long the market after a downtrend day. Before we get started, we have a 2-hour free workshop where I spend 30 minutes going through our proprietary stock selection process, where I identify the lowest risk, highest reward stocks each day. And we also go through 3 top trading setups that we use on our trading desk in New York City. If you're interested in that 2-hour free workshop, click on the link above or go to tradingworkshop.com and check it out. Okay, so today's video, we're going to review potential spots to get long the SPYs after we've had a downtrend day. And before we actually take a look at the SPY chart, I'm going to show you a chart of the SPX because the SPY paid a dividend of about $1.40 a few days ago, and it distorts the levels in the SPY chart based on that dividend. So before we take a look at that, here is the SPX chart from the last week or so, which is going to help us when we look at the SPYs. So we're looking at the SPX chart, and we know last week we had the Fed meeting, and I've circled that day right there in the reaction to the Fed. And then we had a few days of strength. And then yesterday we had this downtrend day where we moved back inside of the range from the Fed day. And following that, that downtrend day, we were looking for spots potentially to get long the market as it gapped higher in the pre-market. So, and we reference those levels from the Fed day as well as the prior day's trading range to trade the SPY. So let's take a look at the SPY chart now. When we look at the SPY chart, I've put three prices. And so here's the downtrend day on the left. The next morning we actually gap up above 292 to a potential spot where we might fail. And I identified 3 spots where buyers might step in. So anytime we have a downtrend day, the next day my expectation is we're not going to have another downtrend day. It's extremely rare. I would say at most 1 or 2 times a year do you have 2 downtrend days in a row. The most common pattern we see after a downtrend day is what I call a faux inside day, where the prior day's low gets violated and then we move back inside the prior day's range. So here we are in day 2, we gap higher to above 292. The thing that's great about after a downtrend day when you gap higher is you have reference points from the prior day to look to see if buyers will step in. And if they step in, depending on where they might step in, if they step on the highest potential support area and immediately gets bought and takes out the morning high, we know that we could have a strong potential reversal. If they step in a little bit lower, potentially the day one's low, we then have an expectation, not necessarily that we're going to have a strong day, but we'll then move inside of the day one's range. And then sometimes we'll have a third spot where buyers might potentially step in, and that's where the Fed day cut came into play, and that's why I referenced the SPX chart originally. Because the Fed day low, I thought potentially that was kind of my worst case scenario where buyers might step in before we'd bounce inside of the prior day's range. We actually took out point number 1 in the pre-market, went back up above 292, and then when the market opened, we hesitated right there at point number 1 for a second, but then went down. So at that point, my thought process was, okay, buyers didn't step in at this 291.5. I'm going to look to see if we come into point number 2, the prior day's low, and we'll see if buyers step in there. Now we see that point number 2 wasn't reached until the afternoon, and when it came down there, it almost perfectly, to the penny, stopped at the prior day's low, popped about, about 50, 60 cents or so, but eventually traded below that level, almost down to the Fed day's low. And that was the area where I wanted to be aggressive, and I was actually aggressive there. And then we popped up about 60 or 70 cents or so. And in this situation, when like we come down to the third potential support area and I'm buying, what I like to see is a quick 50 or 60 cent move where I can sell 30 to 50% of the position, cover the risk, and see what happens. And so that's it. I wanted to just give you a little bit of insight based on the priorities prices, and then also how I can use important days, and that's why we referenced the Fed day from 3 or 4 days ago. And my expectation is other people are looking at those levels as well, and I'm looking to see if we slow down and stop there, and we start to move sideways a little bit, I'll buy. We start to move up very quickly, 50, 60 cents, I'll take some off, so it's a free trade basically. And if it had continued to trend higher, I would piece out another 50 cents up, sell another 25%, and then have a trailing stop and see if we can bounce to the morning highs. In this case, we eventually just rolled over again, finishing at the low, but it was still a nice opportunity. And just to let you know, I'm still working on, I told you on Twitter, I'm working on the risk arb trade. It's just taking a little bit longer to put the presentation together. I've spent 3 or 4 hours on it probably this week, but it will come next week, and I'll give you some good examples. And so stay tuned for a risk arb trade next week. And the second video I'm working on for next week will be this week's options trades that I initiated. So we got a couple of good ones coming down the pipeline, but I hope you learned something here as well.